Well, it's not a scam, but it's a gambling market, and it's not regulated like one. It's not sold as one. It's not presented as one. And I think it's easy to say, well, it works out over the long term. Sure, that little chicanery goes on, but it comes back at the end of the day over some period of time. But that's not always the case. And it's just not, I don't think, the intention of having a stock market. Private equity isn't smarter than you. They're just gatekeeping the best deals. At Vondi Capital, we're tearing down the gates. Go to vondicapital.com and book a call to learn more. Welcome to Control Alt Invest, where we are resetting the world's expectations of investments and Wall Street. I'm your host, Jason Vondersmith. I'm here with James Goodwillie. James, how are you?
Good.
Ready to talk some more shit?
Let's do it.
I tell you this. I'll tell you what. I really, whenever you go out on a limb and try something new, obviously there's always the fear of failure and maybe this isn't any good. I was really encouraged from some of the feedback we got on our first episode. Were you hearing similar things?
Yeah. I mean, pretty good things so far. Especially for first one.
Yeah, and I think it sort of solidifies the goal here of people are wondering what assumptions they're making, or which ones are wrong.
Yeah,
and I think there's a lot, and that's why we got started here. Honestly.
Yep.
So what do you want to talk about?
I think it also because you and I probably made a lot of those mistakes and assumptions in our career.
I've never made a mistake.
Sorry.
Yeah.
Excuse me.
Please don't speak for me when it comes to mistakes, please. So there's I've really enjoyed spitballing ideas with you. What do you think we should dive into today?
I kind of like assets, right? We talked a little bit last time about 401ks. We talked about, ups and downs, good things, bad things about them, things that people wouldn't think about. I think it would be good to dive into asset classes and talk about assets, what's safe, what's not safe. Maybe go down that rabbit hole.
Yeah, because everybody wants this, what's the free, my dad said do this. My mom told me to squirrel away. I remember my grandmother, she 1000%, when she passed away, I remember when my family was cleaning her stuff out, there was tin cans with dollar bills everywhere.
Oh, yeah.
And I think
I mean, that generation especially.
Yeah. So when you say asset classes, I think there's a million things you could come up with, right? Or do you think is it a pretty boxed in when it comes to Wall Street and the general public? Is it pretty boxed in?
Yeah, I think so. I mean, yeah, assets are, I don't have the exact definition in front of me, but I think ultimately it's something that holds value, right? It could be something that holds like an actual tangible value, like in gold's example, right? Or precious metals, they have a value associated with them, but they also have like a utility to it as well. And then there's also assets that don't have necessarily any associated utility or intrinsic value that way.
You're talking about crypto?
Yeah, exactly. I'm sure everyone listening right now is like, oh, like crypto. Yeah. So I think there's a couple different categories that you could probably group most of them in. Yeah.
Going back to the idea of the guaranteed return, or maybe not even a guarantee. I think mostly people they're smart enough to know there's no guarantee.
Yeah.
And that, as the saying goes, there's no free lunch.
Right.
But the flip side of that is when you take a look at Wall Street and, in our prior episode, we talked about 401ks. You might not necessarily know what makes up your 401k, but I feel like there is a presumption of safety.
Yeah, absolutely.
Why does that presumption exist?
Simplicity, I think, has a good amount to do with it. I think probably the majority of the people, when they get those statements in the mail or via email once a year, they see like, oh, I got more money than I had last year. That first page or whatever, when it shows you the summary, it shows a plus. So I think the fact that it's just the standard way of doing things as well is probably a huge thing.
Yeah. When I was in, like many 20-year-olds, when I was in my in that time period in my life, I did a lot of sports betting.
Mm-hmm.
And I remember this one. I know this is a weird pivot, but I promise I'm coming back to where we are.
All right.
I remember this one specific game. It was a Thursday night game. You know, when you're in your 20s, you know everything.
Of course.
There is not a thing that somebody knows that you don't already know, especially when it comes to sports. You watch enough ESPN, you do know what's going to happen.
Oh, yeah.
I can promise you.
For sure.
And there was a Thursday night Rutgers game. This was when Rutgers was starting to get good. Remember Ray Rice? When Ray Rice was there?
Yep.
And Louisville was playing them. And I thought Louisville was good. And I thought Rutgers was garbage. And I spent 5 days telling every one of my friends that also bet on sports that Thursday night, we are going to get rich on Louisville. It was at Rutgers, laying points on the road.
Love it.
They didn't get killed, but there was a field goal that Rutgers hit that won the game.
Yeah.
And I remember being at this bar, and I remember it was a friend of a friend because he was, I think the other thing you do is it's easy to lean into someone else's confidence in that scenario.
Oh, yeah.
And this is the tie back to Wall Street. When Wall Street comes along, or your financial advisor or whoever, this is, well, you know, these stocks, these Latin America stocks might be risky. You know, the mortgage crisis happened a while back. Like, maybe that's a little risky, but I got these bonds.
Yeah.
Or I got this and I got that. And the way they talk about it, and, you know, they watched a lot of ESPN. They must know what they're talking about.
Yeah.
And so you lean into that. I remember just this one guy specifically he never let me forget it. I saw him randomly through the years because we weren't like great friends.
Sure.
Every time I saw him, he brought it up. You got anything else like Louisville? So I think it's easy to lean into someone else's confidence in that situation.
Sure.
It's for most people, it's easier to spot a sure thing in sports. We all know that's not the case. But how do we spot the not sure thing on Wall Street?
Oh, do we have enough time for that? Yeah, I mean, you're right. Right. The confidence of these Wall Street guys or analysts or investors that are talking to you, coming to your office, right? They show up in a nice suit and tie to your business casual office, and they sit everyone else in a room and talk about their 401ks and their plans and their this and that, or they you know, a financial investor, or I mean, a financial planner, you sit down and they throw out acronyms about all these different things. And you sit down and you're like, well, you know, I've been doing a good job and putting money away here, putting money away there. I've got my kid's college fund. I'm doing all these things right, from the typical American standpoint. And then you say, I want something not risky, right? I want something that's just going to guarantee money. It's just going to guarantee returns. They're going to have an answer. They always do. They're going to have an answer. They're going to, oh, it's funny you said that, because you know what? My company or my sponsoring brokerage or whatever has this, and this. And yeah, I think everything has a level of risk to it. And that's one of the big misconceptions is what has risk and what doesn't is what kind of people assume, right? If I put cash under the bed, zero risk. But there's still a huge amount of risk that goes with that. Not necessarily risk of losing all of your money, because that's not going to happen, but it's always going to depreciate, right? You're never going to make more on cash than inflation. So you're going to be losing money technically.
So let's take a step back. If I just showed up on Earth, I'm an alien.
Yeah.
Which is another fun pivot to make.
Mm-hmm.
And the only thing I know is money. I know that money exists. So, but what I don't know is what I can do with it. Walk me through the array of options when it comes to investments, of course. Like, you know, of course you can go buy something.
Yeah.
But when it comes to, I want my $10 to be something more next month, what are my, broadly speaking, what are my options?
So first one you've got is cash, right? You can just hold it.
But we said, I want my 10 to be, it's not going to double itself.
No. So when I say hold it, you could like your rest in peace grandmother could put it in a coffee can and bury it in the yard. You could also put it into a savings account. That savings account is going to say, since you're giving me the money, I'm going to take it. I'm going to go spend that money or invest that money. And because you're letting me do that, I'm going to guarantee that you get a percentage back on that money. Maybe it's 1%, maybe it's 0.5%, maybe it's a piece of nothing. So that's one way, right? It's just hold the cash in a savings account.
Got it.
And keep it. Then you have bonds. Everyone's heard that magic word. And that's basically a very similar thing, but it is you give a government, or whether it's a federal government or a state government, right? The municipal bonds and things like that. And then, or you could go corporate bonds as well, like businesses and stuff. And they are, you give them your money and they say, because you gave us that, we're going to pay you back with interest. After that, you've got equities, stocks. Everyone knows that as well.
Yep. And
that kind of encompasses the individual stocks. If you want to go buy a tiny piece of Apple, you could do that. You could also go buy an index fund or a ETF or something like that, which is a piece of a lot of different companies. Then you have plenty of other things like commodities, which is, everybody's heard of oil. Everyone's heard of gold,
sand
silver,
futures.
Sand futures. Perfect. Shout out last episode. So those are tangible things, right? Like they have a utility to them. And so you can buy into those. And then you could also, there's a lot of other complex things such as crypto and derivatives and a lot of other things. But those are kind of the big ones.
Yeah. And I think that's and that's what I wanted to get at. I wanted to box it in, right?
Yep.
And so if we start with, if our goal is safety, maybe as an alien, I took the risk to come here, right?
Yeah.
So I've got a little gumption.
Oh yeah.
But I'm not betting on Louisville on a Thursday night. So you mentioned the guarantee of a savings account.
Yeah.
How much of a guarantee is that? Can they ever stiff you?
Yeah, kind of. Right. There's banks can fail. And that's kind of we'll start there. Yeah. Banks can fail. Do they fail often? No. And the ones that do fail, if you look at the giant proportion of banks out there in the world, the chances of yours failing, super, super slim. And then even then, if they do fail, they could get bailed out or they could get sold or get purchased by another bank who will then honor your deposit. So very, very little risk there. And then there's also the FDIC. The FDIC, for those unaware, basically guarantees, federal government put it together, guarantees a certain amount of money. I think it's $250,000, and they'll guarantee that. So if a bank does fail and you have less than $250,000 in that bank, the FDIC is going to guarantee that and that they'll pay you back that money.
Okay, so great. I'm glad you mentioned that because I was going to say if I put my $10 in a savings account and they say you can have, I know it's not this, but you can have you get a 5% return.
Yeah.
So every year I'm getting 5% of my $10.
Yeah. So in that regard, it's safe pretty much. The big caveat to that though, in the hidden danger is inflation.
All right. But before we get to inflation, let me finish that thought. So if I can get 5%, they pay it out in a certain time. So like you said, the statement shows up, I got a plus, now my $10 is 11 at some point.
Yeah.
The bank fails.
Mm-hmm.
Now you mentioned the FDIC, but if that bank fails in 3 years, I'm only getting back what I put in. Yes?
Good question. I honestly don't know.
I'm going to look that up.
Yeah, please do. I think it's whatever the balance is when it fails.
Okay. Because what I was going to say was even then, I've missed out on that time with my $10 if I'm not getting back the gains.
Yeah, so they're gonna do it just kind of like like any loan where they pay you, they kind of amortize it. So like they'll say, all right, you get 2% per year, but that 2% is going to be divided by 12 months. And so they're going to pay you a little bit each month. And so whenever that bank fails, it's whatever has been accrued up until that point, whatever the balance is at that point.
Okay, great. They just lowered it too. Something just happened in August. Yeah, go check your bank accounts. Make sure that they dropped it.
What's the number?
It says, it's more than 250. But I thought 250 was always the number.
Yeah. Inflation.
Yeah. Ask AI. They'll figure it out.
There you go.
All right. So we beat that to death. the inherent safety there. All right, so now I want more. I say that 5% is not enough. Now I'm really excited that you brought up bonds because I feel like that gets thrown around a lot. They talk about now what you went through, is that the same thing as like the treasury bonds? Because that's indicative of stock moves too, right?
Treasury bonds?
Yeah. Like, they always talk about the inverted yield curve or something.
Yeah. I mean, that's still more tied to the bond market itself and inflation, right?
Okay.
So the inflation for most of basically every safe, quote unquote, safe asset, cash, bonds, all of those are going to be heavily tied to inflation. So with cash, if you have 2% a year and then the inflation, like it has been in recent years, is 3, 4, 5%, you're essentially losing the buying power of that money. So you're not losing money, right? You're not going to go into your bank account and be like, oh, I had a savings account with $100,000 and now it's $70,000. That's not necessarily the case. But if everything in the world is more expensive, that $100,000 gets you doesn't get you nearly as far as it did when you had that money originally, right?
Right.
So it's kind of like a shrinkage of your wealth into a certain aspect. Bonds, on the other hand, are tied loosely to stocks in the sense that if interest rates start to climb, people may go and buy those bonds and move out of stocks, and vice versa, right? If interest rates drop, they may move into equities and jump out of bonds just to kind of diversify, but they're more tied to the interest rates themselves.
Oh yeah, diversification. That is the free lunch. I'm pretty sure, right?
Yeah. If your advisor mentions diversification, just go with them.
That's it.
That's it. Let's end the episode there.
Do you think Edward Jones would hire me? I can just call up somebody says hello, and I say diversification, and then boom.
Yep.
I like this. This has legs. So again, I've got my $10, and I want to. Now I'm interested in corporate bonds.
Yep. Corporate bonds. Okay.
Right.
Yeah.
I like the way you put that it's a loan to. But do companies do that? I've never heard of a company saying, "Hey, I want to take on some debt." So, or is it just all through the secondary market?
It is probably primarily in the secondary market. Like you can't just go on Apple's website and be like, I'd like to loan you some money, Apple.
Yeah.
Right. Not going to happen.
Right.
And I don't even know if Apple has corporate bonds, but I do know they exist. And they have different ratings. I don't know if they're the same as like the mortgage-backed securities where they, had AAA, AA, and all the way down to junk. But I do know they have different tiers, and you have to know a little bit about that.
I'm so glad you brought that up, because that goes back to my guarantee on Thursday night. That's an A+ rating.
Yep.
And I very easily could have gotten that rating if I had the right buddy who ran a rating system.
Yeah.
I'm being coy here. I mean, this is essentially what happened. We keep going back to this mortgage crisis, and maybe we should do an episode on that just for historical context. But we don't need to rehash that crash.
Yeah. But anyone who wants to see that, just go watch Big Short. Incredible.
Yeah, that's a great call out. I mean, they explained it so well.
Yeah.
And Margaret Robbie, she's a phenomenal actress. Very talented.
Yes, very talented.
And she's in it. That's why I brought that up.
Yes.
Yeah.
For about, 30 seconds?
Is that it?
Yeah.
I thought she was a main character. So I want to buy corporate bonds. My friend at the bar gave it an A+ rating.
Yep.
So I feel good and warm about that.
Yep.
And I feel good about this interest I'm getting back. Now, that corporation, they're just taking the loan. They go do whatever they want. Maybe they fail, maybe they don't. Maybe you get your money back, maybe you don't.
Yeah.
But we're trying to lean into what is a safe investment here.
Sure.
And as a savvy investor, which of course everyone has access to the internet now. I don't know if you knew that.
Oh, whoa.
Yeah.
Okay.
So you can look up. That's right. You can look up. You can look up whatever you want.
No.
And you can get the internet to tell you whatever you want to hear.
All right.
This is breaking news.
Yeah.
If I had a breaking news button, I'd push it right now.
Burr, burr, burr.
So you're going to look into this company. You're going to look into, you said Apple. I can't think of another silly example. Oh, Enron. Okay. You
love it.
Yeah. You look into Enron and you see that they're printing money. They're doing great.
Yes.
Their leadership, phenomenal.
Yep.
And they're even a little sarcastic and wily with the reporters.
Yep.
Yeah, they call them assholes and stuff.
Yeah.
So these guys know what they're doing. You've done your research. The bond is rated A+. Boom.
Yes.
Now what?
Well, in Enron's case, you get fucked. But I loved your analogy of like my friend at the bar rated it a AA or A+ or whatever you said, because that's a very apt description of these credit rating agencies. They're for-profit entities, right? So I know you do a bit of dabbling in like sports cards and stuff, right? You know how you send it off to like PSA and you have to pay to get them rated? It's the same thing. And so if a massive company like Enron is sending all of this business to Moody's or whoever is rating these, and there's a bunch of different credit rating agencies, if they're sending a $1 billion worth of business to get these bonds valued, if they don't have a high enough rating or the rating that that Enron hopes that they're going to be rated at, then they'll take their business elsewhere, right? So it kind of forces these credit rating agencies to, for lack of a better term, bullshit the actual ratings of these bonds.
Yeah. Intuitively, I know it's risky, but that's my buddy. I'm sure they're smart enough. They'll figure it out.
Yeah.
Speaking of documentaries, it's called The Smartest Guys in the Room, and that's about Enron.
All right.
That is, I've watched that 5 times.
It's that good, huh?
It is so good. There's one reporter. God, I forget her name. She was calling them out the whole time, and she's sort of the main character in this documentary. But it's so good. It's so good. I think it's on Amazon. So okay, so now we're bonds are not the safety net we thought that they were.
Yeah, and that's just corporate bonds, right? I mean, you got treasury bonds. Like I said, you've got federal bonds, and you've also got like local bonds, right? Each county, state.
So I'll play ignorant here.
Okay.
I think I'm smart enough to realize that when we say federal and local, instead of loaning to a company, we're just loaning to the government.
Yeah.
What do we mean when we say treasury bonds?
Treasury bonds are glorified IOUs. They will, and for most cases, anyone can buy them. So the public can buy them, but also countries. And we sell a ton, and that's a whole nother can of worms we could open up, is the countries that own large swaths of our own bonds. But basically IOUs. You pay a certain amount to the government gets to use that money, they spend that money, and they pay you back interest.
Oh, so it's the same thing.
Yeah. It's the same thing as a corporate bond, basically. It's definitely safer, right? Because like, when was the last time that the U.S. defaulted?
Right.
So it's definitely safer there. But going back to inflation, and interest rates, the Fed's going to jack up those interest rates and everything. Things change quite a bit. When they drop interest rates, things change quite a bit. And so, like recently, 2022, huge bond crash in terms of the returns on those. And so they are safer, but safer is still not safe per se.
Yeah. All right. So where else? So then we can call local bonds, federal bonds, treasury bonds. We can lump them together.
Sure.
Great.
Yeah, pretty much.
Okay. So I don't like being in this savings account. I don't feel good there.
Yeah.
Honestly, everything you're saying, I might get on my UFO and go back to where I came from.
Yeah.
So, but keep me around.
All right.
I don't like this IOU bond bullshit you're talking about.
Yep.
That sounds like a scam. And in fact, I was reading the other day, it had to do with, I guess there were the big banks when World War II was going on, or that time frame.
Yeah.
There were the big banks coming up. They were heavily involved in the government, which is, I can't wait to get to those episodes and to talk about that stuff. President of National City Bank, he was a shadeball, Charles Mitchell.
Okay.
You know Charles Mitchell?
I don't know.
He's a character. But they were the largest bank in terms of assets. This is from all the president's bankers. This is straight out of that book. He dumped loans, and so this is what you were talking about. So he dumped loans into countries that couldn't pay for him, and he knew they couldn't pay for him. And then he sold them back to the American public as like a bond. So again,
love that.
Yeah, you're diversifying, which is great.
Yeah.
I don't know when Edward Jones came around, but they were telling people back then to diversify.
Yep.
You went to National City. You said, I want to be in a safe bond.
Yep.
And they said, great, we're loaning money to Kazakhstan.
Yes.
As it were.
Yeah.
I don't know the outcome, but I don't think it was all that.
Yeah.
It wasn't always positive.
Yeah. Yeah. And there are plenty of people here listening that are like, well, I've had bonds my entire life and I've been safe and I've gotten the returns that I need off of them. And yeah, when all things considered, bonds are super safe, right? In terms of a normalized return, things like that, they are very, very safe. But kind of one way I would describe them is they're like that batshit crazy ex that you had that you didn't know was batshit crazy until like 2 years in, right? So everything is like stable, it's safe, you guys are in love and it's all great and everything's perfect. And then you go on that like 1 weekend golf trip with your buddies and you come back and like everything is like shit has hit the fan, right? Everything's upside down. That's kind of what bonds are, right? Like everything could be great, feels great, looks great. And then at the drop of a hat, 2022, and then it's like, oh my God, where'd my money go? Because like your returns could just be wiped out or a fraction of them are wiped out. So relatively safe, but still some.
Yeah. Yeah. Okay. All right, let's move on from bonds.
Yep.
What's next?
Probably equities, right? So stocks.
Yeah.
Right. You own a piece of something, some company, the future profits, the existing profits, the future success, all that stuff.
I remember as a kid, as parents as they do, they try and get you to start understanding some of this stuff. They talked to me about stocks at a very young age. My aunt, when we were born, bought a stock in McDonald's.
Mm-hmm.
Funny enough, I just sold that a couple months ago.
Nice.
Yeah.
Just one. She gave you one share.
Yes, kind of. I can't remember. It wasn't very many shares because it was like, ants how they are. They're like all about it, and then they forget what they were doing.
Yeah.
So I think I had 4 or 5 shares.
Okay.
It was like $1,000, I think.
Yeah.
After how many years? After how old am I, James? I don't even know. So yeah, 40 years to get $1,000 out of it.
Yeah.
And who knows what the stock price was back then. But I remember, as a kid, my parents were trying to explain to me. I was like, well, what about the Orioles? Can I buy stock in the Orioles? I think they told me yes, but I remember going to, I think I did that. This might have been middle school. I tried looking up like stock tickers on whatever newspaper.
Yeah.
And was trying to find the Baltimore Orioles. But I'm pretty sure it was privately held.
Yeah. Yeah.
So stocks are another avenue to invest. And that's probably the most widely known.
Yeah. Yeah. I mean, everyone knows what a stock is, right? They know something about it.
What makes them so dangerous? Because you brought up Apple. Apple's as solid as they come.
Yeah.
Everyone's got an iPhone. Everyone's always going to have an iPhone.
Yeah.
Most people are going to have a new iPhone every year.
Mm-hmm.
Most people are going to have a new iPad every 5 years.
Mm-hmm.
Got the watch, right? You're getting sick. You put the Apple Watch on somebody who's, sorry, when I say sick, I mean just like as you're older, you're concerned about a parent or somebody that's living by themselves. You get them the Apple Watch. You get alerted if they fall.
Yeah.
That's a safe company to be in.
Sure.
Right?
Yeah.
Now, Apple's stock has gone down before, though, right?
Yeah, of course.
And is it because of did people stop buying iPhones?
No, I mean, not necessarily, right? I think when it goes down, typically it's because they miss expectations, right? It's like they still sold 1 million new iPhones, or I'm just pulling this number out of my ass, but like they sell 1 million new iPhones, but everyone thought they were going to sell 2 million. And they're like, well, that's terrible. We're going to drop that stock, or we're going to sell it, right? Not drop it. We'll sell a bunch, right? These institutional investors, right? Or some guys on Reddit. And so they'll sell this and the stock price goes down. But just like any stock, right? If you ever look at a stock, nothing ever goes up all the time.
Well, and I think that's what I'm getting at is that, I think I've mentioned this before. I love to think about who bought the first stock.
Yeah.
Right? What was the first trade? What was the first exchange? And what was the sales pitch? Because in my mind, and I might be repeating myself from something we talked about last time, but if I go in, you used to have to go into or you had to know somebody, a broker or somebody,
Yeah.
and they would call in. I
Yeah.
want 3 shares of McDonald's.
Yeah.
If I'm the first person buying a stock, I want to say, okay, if McDonald's sells more hamburgers and keeps doing their thing, my stock is going to go up. I guess what I'm trying to get at in a very poor way is that they go down for no fault of their own.
Yeah.
So if you're like, I want to be in this blue chip stock and it's relatively safe, it's kind of not. And if I'm landing on Earth again and I've got my $10 and boy, do I love McDonald's hamburgers. So I buy a share of McDonald's stock and I keep buying more hamburgers.
Yeah.
I'm thinking my money's gone up, but then the pandemic hits or something else happens. No, I guess the pandemic would inherently impact how many people are going to eat at McDonald's. So maybe that's not a fair thing to say. But if I'm in a stock and it goes down, I want to say, okay, it's because they suck.
Right. Yeah. Yeah. I mean, there's just so many things that go into the fluctuations of a stock. And I think that's exactly what you're getting at is spot on, right? You've got company performance. So to the example that we were using with Apple, they sell less iPhones than what people thought, or they sell just less iPhones than the quarter before or whatever. Company performance can impact the stock, but also just market sentiment, right? Prime example with that is GameStop. They had no business having as high of a valuation and their stock price being as high as it was, but the sentiment of thousands of people on Reddit were like, let's fucking buy the shit out of this thing and send it to the moon. And they did, right? So that's another thing, market sentiment. If a bunch of people just got together and said, we hate this one stock, it can go down drastically. And it doesn't have to be 1,000 people on Reddit. It could be one giant hedge fund that has $1 billion in a smaller-ish company that says, I don't like this anymore.
Yeah.
Right? So market sentiment, and then just economic cycles in general, to your point about COVID, the pandemic or the .com bubble or whatever. I mean, any economic cycle can also swing things drastically.
Yeah. There was I spent a short period of my life trying to learn how options trading worked.
Yeah.
I thought that would be cool to take a shot at.
Yeah.
What I learned, and it's similar to what you're talking about with GameStop, there's people that, and you mentioned derivatives before.
Yeah.
And I'm not, we don't need to give an education on what the derivative market is. But if you've been to Vegas, I'm sure you can quickly find out what the derivative market is. One of the things that they would do is they'd be able, through charting, they can identify where the bears and the bulls are.
Yeah.
Who's betting it's going up and who's betting it's going down.
Yeah.
And by their actions on buying more puts, which is shorting it, which is betting it's going to go down.
Yep.
Through those sort of actions, they do, because you can, if you buy something on the stock market, you can set a stop. Most of the software, it says, like remember when E-Trade was new?
Sure.
And you could trade your own stocks for $5 at a time.
Oh yeah.
You could put in like a stop loss. It's like, okay, automatically sell if it gets to this point.
Yes.
They can sort of chart out where that exists, take their own actions that ends up squeezing one of these groups out. And then you see those big swings.
Yeah.
So if you have a plumbing business and you want to invest in equities for your long-term future to say, hey, I'm going to save some of this money. I want some kind of return. I don't think you can have time to pay attention to what the fuck these people are doing with options trading that's squeezing out your McDonald's stock.
Bingo. Yeah, you're exactly right. And then on the flip side of that, right, somebody is shorting your stock and driving it to the ground. Then you also have, these short squeezes where you have a counterpart on that short and some big company or a group of a ton of different retail investors, average Joes, get together and say like, no, we're going to try and squeeze them out. And so they try and drive it up while the other one's trying to drive it down. None of this has to do with how many iPhones they're selling.
Yeah.
Not a single one.
Yep.
And so I think it's a roller coaster. It's a full out roller coaster.
Well, it's not a scam, but it's a gambling market. And it's not regulated like one. It's not sold as one. It's not presented as one.
Yeah,
And
yeah.
I think it's easy to say, well, it works out over the long term. Sure, that little chicanery goes on, but it comes back at the end of the day over some period of time. But that's not always the case. And it's just not, I don't think the intention of having a stock market was that this kind of nonsense.
Yeah, I think it was exactly what you mentioned earlier of like, back in the day, I really liked McDonald's. I bought a piece of McDonald's because I liked it. I liked the product. I liked what they made. I think it's going to continue to do well. I think they're going to franchise. I think the business is going to boom, and I want a piece of that revenue. So I'm going to buy a piece of that company so that my money gets into a pool that they can then use to grow that company, right? Like, I think the premise of it is great, but when you start adding in all these other layers, you're exactly right. That I don't necessarily know if that's what it was intended for, but what it's done is add a ton of market volatility. Now, you could probably make the case that even though the day-to-day volatility is higher, the overall volatility may be lower because there are measures now where it's not just directly tied to performance. So it may, in some cases, I haven't looked exactly at the data, but I'm sure you could make the case of maybe over the long term, it's a little less volatile because there are, you can short companies, you can do things like that. Every financial advisor or whoever you're talking to is going to tout the fact that the stock market goes up, right? There's blips, you have recessions, you have things like that where things dive. But overall, if you look over 50 years, the year-over-year return might be, if you factor in inflation, maybe 7%, right? If you take like S&P 500. So all these companies combined, 500 of them, you look at all of their performance, combine it into one, goes up 7%. But that's just looking at the peaks, right? That's just looking at the actual value of these companies. It's not necessarily looking at like, all right, well, John Smith out in Arkansas who bought that S&P and, or bought some of those companies in that S&P, he didn't, you always hear this buy the dip, right? Buy the fucking dip or whatever it is on Twitter and other outlets. But, did John Smith out in Arkansas buy the dip, or did he buy it middle of the way through? Did he buy it at the top and then sell when it was at the bottom, right? So yeah, 7% may be the average of what the stock prices were, but who actually cashed that out and got that? That's a big question mark. Did the hedge funds take 20% and the retail average Joes get 2%?
Yeah, I can't wait to dive more into these conversations of who's actually making the money.
Yeah.
Because there's so many layers in between. But you mentioned the stock market always goes up, and I started to laugh because I was thinking about this, and I'm not a big Rogan fan. I love UFC.
Yeah.
I enjoy podcasts, and he's in both spaces, and so I want to go, and I love stand up comedy. He tries that. That's one thing I don't think I can't get into his stand up at all. But I did see a clip the other day, and he was talking about something that happened like 3 generations ago, and his point was sort of comical about that was 3 people ago.
Yeah.
The stock market always goes up. That was what, 1 person ago?
Yeah.
This is not hundreds and hundreds of years of like, you know what I'm saying?
Yeah.
And you only have this one lifetime where, we all know life is short. So you want to play this game where, well, over, what do people throw out? 20, 30, you said, what did you say, 50 years?
Yeah, 50 years.
Who the fuck has 50 years
right.
to wait for all this stuff to work out to go from, to get my 8% year over year?
Exactly. Yeah, you're exactly right. Now, for anyone who didn't listen to the last episode that we did on 401ks, we kind of briefly touched on this, but what happens when you get to that point where you're at the point of retirement, or maybe it's not 50 years, maybe it's 30 years, and you hit that point of retirement, 59, 60, 65, whatever it is, you hit it in 2001. Right. You hit it in 2008. You hit that age in 2020. And luckily 2020 it was very drastic, but it was very quick to change. But what happens then, right? Like, all right, shit, dude, now I have to work till I'm 75,
right?
Till I'm 85. Like, what does that do? And so that's kind of to the point about the roller coasters. It's even though on average it goes up, averages are shit if it doesn't fit what you actually need in your own life.
That's right. So we're kind of poking holes in some of these safety mechanisms and what feels safe, of course. I know there's other asset classes, and some of it goes to, like, it's not an index fund, but can't you broadly invest in real estate at like
Yeah.
Like at an institutional level?
Yeah. So similarly to, we've mentioned index funds and where you can buy, if you have $100, let's say, Apple's stock price is 250. You can't buy a single share of Apple. So what you can do is you can go invest in these funds that kind of pool money together and go buy enough of these different companies on your behalf with a bunch of other people, so that you can kind of own the companies that you want without having very few people on earth could probably go buy a share of Berkshire Hathaway, right? So I don't know the exact price, but it's probably hundreds of thousands of dollars per share. You can't just go do that, or at least most people can't. So, but you can buy an index fund, and that index fund could have a couple shares. And so when Berkshire Hathaway goes up, that you get a little kind of fraction of that, right? So that exists with equities and stocks. It also exists with real estate. And so those are, there's a couple different types, but the most prominent one is real estate investment trusts. So REITs.
The REITs.
Yep. REITs.
Yeah. And what are they? So, and you said they work similar where who can put those together? Could I go sell if I had, I'm sure I need a license or something, but could I go build my own REIT and sell it to the public?
Beats the hell out of me. I'm sure there's a lot of legal and loopholes you got to jump through, and a lot of certifications and things that you have to get. But they basically work the exact same, except instead of equities, you're buying a fraction of a pooling, and that pool may own a bunch of different things, right? There are real estate investment trusts that solely own apartment complexes. Yeah. There are some that own warehouses, some that own homes, right? Some that own primary homes, some that own storage units, some that own beach condos, and then some that own kind of a wide variety of all of that.
So we our goal here is to potentially point people to safety as much as we can.
Yeah.
And we know that there's no free lunch.
Yeah.
When I think of real estate, I see the upside.
Mm-hmm. But yeah, most do.
But there's risk there too. How do you feel like your risk is managed in whether it be your own real estate investment or a REIT compared to, because if I have an investment property,
yeah, I
can buy insurance on that.
Yeah.
That's my FDIC for my savings account.
Yeah.
I can do that. But not always. I mean, if you buy if you buy a beach house in Florida with the hurricanes lately, like insurance isn't that. I think they try to wriggle out of that.
Yep.
So if I invest in a REIT, what's my safety net look like there?
Good question. I mean, they do have their own, to your point, they all have insurance, and because they're financial institutions that are putting these things together, in most cases, they're going to avoid the things that they can't get insurance on, right? Like a good REIT is not going to go buy a bunch of beach houses in Florida because they, to your point, or in California where they can't get any insurance on that. So there is definitely a level of protection. It's a little outside my wheelhouse in that regard, but it does give you more protection than if, you're over there and you're like, holy shit, I'm looking in Tampa right now and I could go buy a piece of land in Tampa and build a house on it for $500,000. Maybe I'll do that, right? Without knowing the permits, without knowing that you're not going to get insurance, without knowing any of those things, flood insurance, how much that costs, all those types of things. The real estate investment trust is a little bit easier in that regard.
Yeah, that makes sense. And I'm looking at this public storage REIT all time. Now I wouldn't have guessed that. When would you have guessed public storage REIT? Maybe even just the REIT when they made that.
Oh, I don't know, 20, 30 years ago, maybe?
1972.
Okay. And 50 years ago?
Lifetime on this REIT, 2,000% is what it's made.
Yep. Yeah. I mean, when I started looking at numbers of some of these REITs, it's staggering in many cases. I mean, the S&P 500 is the gold standard of consistency, right? And everyone thinks that, at least. And to some degrees it is, but there are, just on the REIT side of things, there's probably 24 that have absolutely smoked the S&P 500 over the last 20 years, right? And that's a real, in my opinion, I think that's a realistic time frame to look at something, right? You know, if you're 40, all right, I'll retire at 60. I mean, if you could guarantee, not, and obviously guarantee is a strong word that I shouldn't use here, but like if you could estimate that and all I got to do is stay with this thing for 20 years, that's more realistic. And some of these things, right, like you mentioned, self-storage, some of these things are a lot more recession proof than many others, right? Like people from the storage side of things, I mean, people hoard 24/7.
Right.
You know, they're not getting rid of their shit.
Oh, I love storage.
Yeah.
You know that about me.
Yeah, I definitely know that about you. But like, you know, they'll sell their car before they'll get rid of or try and sell their 20 boxes of child clothes that they had when their child is now 18 years old and they don't need those child clothes. Or the Beanie Babies that they have in like 6 different bins that they bought 30 years ago, right? They'd rather sell their car than the Beanie Babies. And so people are always going to hoard. So like, you know, just going down that rabbit hole of like storage, but storage isn't the only one. I think it's the same across the board. And I do think we need to talk about the risks as well, because real estate is very dependent on the area that it's in.
Mm-hmm.
There's inherent risk there, right? Like, you know, the oil boom and bust cycle out in Texas decades ago, right? Like where all these towns popped up and then because there was oil and then they just vanished, right? So like if you know, there is risk to certain things in the real estate side, of course, but yeah, it just kind of blew my mind that, you know, there's 24 REITs out there that over the past 20 years have smoked the S&P.
Yeah. I think what I always go back to with real estate is that at the end of the day, it's still a plot of land.
Yeah.
And that has inherent value.
Yes.
It's never zero.
Yeah. That's a great point.
It's never zero.
Yeah. It's never a blockbuster.
Yeah. That's right. That's right.
Or Enron.
Enron. Smartest guys in the room. Have I ever told you about that?
Yeah. Yeah. Once or twice.
Yeah. That's pretty wild.
Yeah. It's just interesting, right? Like and it's no fault of anyone's that is out there that has their money in the S&P or has it in index funds or has it in bonds or, you know, good for you, right? I don't think there's anything inherently bad. I think just, again, to our point of all these episodes and episode that we did and future episodes to come is just the educational piece, right? There are other options. There are things out there that may fit you a lot better than and may perform a lot better than what you have now. And, you know, if you don't know anything about real estate and you look at that idea or you watch Grant Cardone and folks and you're like, I'm not going to go buy a 2,000 unit apartment complex in Miami. There's no possible way I'm going to do that. But maybe you don't have to, right? In order to get similar returns.
Yes, that's a great call out. I'll say it. So I sold residential real estate for about 5 years.
Yeah.
And I worked for a company, Keller Williams.
Mm-hmm.
Guy who started it, his name was Gary Keller.
Mm-hmm.
Funny enough, Keller Williams is the name of a band too. So if you search it, you're like, that guy had a band? No, he did not.
Interesting.
So Gary Keller would say, know what you know what you don't know, and know the difference between the two. And what really bothers me and why I start to get fired up when we talk about this stuff is most people lean in, again, to where we started from, the confidence of their broker or whoever's selling them their wealth management. And they lean into that instead of saying, well, wait a minute, there is no free lunch. What else is out there?
Yeah.
Because they don't tell you the whole world of possibilities. You have so many.
Yes.
And to your point, yes, you can invest in a REIT. Again, maybe you have a plumbing business, maybe you build houses, you don't have time to like actively manage it. And there's a place in this world for people who there's plenty of great wealth managers out there that will help you, right? You hire that out. But it's important to know that those options even exist, and most people don't.
Yeah.
So.
Yeah, I agree. I mean, there's I love the saying, but there's a million ways to skin the cat. And simply because your dad's got a buddy who does financial planning and is going to pitch you certain services doesn't necessarily mean that's what you have to do or what you should do. You know, there's tons of different options out there.
Yeah. All right. So we can wrap it up this way. We've talked a lot about safety.
Mm-hmm.
We role played an alien.
Yeah, we did. A McDonald's loving alien.
So I'm not going to do this. Look at me. I'm not going to do this. But I give you $1,000. Right. I'm not giving you $1,000. If I give you $1,000 right now,
yeah,
what do you do with it?
Oh, diversify. diversify. No, it's a good question. You know, I think I would probably, you know, I joke on diversifying, but I probably would, to some extent, break it up into certain ways. You know, I'd put some into a safe-ish option like bonds. You know, put some into an index fund, maybe. But I'd probably, after learning what I've learned for the research for this episode, I probably would tailor more towards real estate.
Yeah, I know what I would do. I'm betting on Louisville.